we were discussing about fixed income securities or bonds, and last week we discussed how to calculate the accrued interest and price of a bond on a coupon date. So I hope you can remember those concepts. What is accrued interest? That's the interest accrued on a bond from the last coupon date to the current settlement date. When the current settlement date falls before a coupon date. So that means in between coupon dates, if we trade, what is the interest accrued on the bond from last coupon date to the settlement date, and which belong to the seller, current seller. So he should be compensated for his holding period. So therefore the buyer should pay that accrued interest to the seller on the settlement date. So this is the equation to calculate the accrued interest. Basically, what is the concept in this? First part is the coupon. We calculate the amount of coupon and prorate that coupon amount according to the number of days in between the last coupon date to the settlement date and number of days for the current coupon period. So the second portion of the equation is calculate that fraction. So based on that fraction, we prorate the coupon for that period. So we did an example for the whole coupon period. There are 181 days, and in between the last coupon and the settlement date, there's only 136 days. And we know the coupon rate, coupon frequency, face value, and now we know this fraction, that is 136 days over 181 days. So once you substitute all those figures and calculate, you'll get this amount. What does it mean? When this bond is sold with the settlement on 31st May, the bond buyer has to pay the bond seller this amount of accrued interest apart from the price that he is going to pay. But again, when it comes to price, there are two prices, clean price and dirty price. Clean price is the one which does not include the accrued interest component. Once we include that accrued interest, then we call it as the dirty price. So when I say apart from the price, that means that this clean price. So altogether, the bond buyer pays dirty price to the bond seller. So now the problem comes how to calculate this clean price or the dirty price. For that, we start discussing this, how to calculate the price of a bond. But we started it with the how to calculate the bond price on a coupon date. So whether it's on a coupon date or not, basic principle is the bond price is the present value of the future cash flows. So in a bond, we know, especially with the fixed coupon rate, we exactly know what are the cash flows. What are the cash flows? Coupon payments on each coupon date and the face value on the maturity date. So we have to consider all those cash flows. These equations tells us we have to calculate the present value of each and every cash flow and add them up to get the total present value, which is the price of the bond. That's the basic concept. So to calculate the present value, we need the interest rate, which is the required rate of return. Later we will call it as yield to maturity. So this is the basic equation. If you go by the fundamentals, then we can see when the coupon rate is fixed, C1, C2, C3 up to Cn are the same figures. There's no difference. So this part can be considered as an annuity. Then we have an equation how to calculate the present value of an annuity. We use it to calculate the present value of coupon payments plus the present value of the face value. Still, you get the present value. That means the price of the bond. These are the concepts. But if you want to use Excel, in Excel there's a inbuilt function that you can use it directly. For that, you need maturity date and the settlement date, coupon frequency, coupon rate, and rate of return. But the face value, the Excel function gives the price for a 100 face value bond. Then you have to adjust it or use that price to calculate the price of a bond with any other face value. So we did an example with this 1 million face value, coupon rate 5%, annual coupon, maturity date December 15th, 2025, settlement date December 15th, 2021, and the required rate of return 5.25. So first we calculate the coupon. Since it's annual coupon, just 5% of face value is the coupon amount, 50,000 at the end of each year. What is the maturity period? 4 years. So therefore there will be 4 cash flows, each equal to 50,000, and the last cash flow will be in addition to 50,000 there will be the face value. So 1,050,000. Now what is the required rate of return? It's 5.25. We have to discount each and every cash flow at 5.25. So that's what we did here. You add them up, you get the price. If we can use the annuity formula, then we can consider first 4 coupon payments, the annuity. So then the annuity amount is 50,000. Number of periods are 4. Rate of return required is 5.25. Just substitute those figures into this equation. Then you can get the present value of the annuity. But it's not the present value of the whole cash flows. There's another part remains there. What is that? That's the face value. So we have to add the present value of the face value. Then you should get the same answer as we got here. So that's the basic. Then we did another example with semi-annual coupons. Only difference is the coupon amount would be half of the previous one, and there will be more cash flows because there are cash flows in every 6 months. And remember, we don't worry about this dates, specific dates, but what we need, number of coupon periods. So this is what we need to calculate the present value. There are 9 coupon payments and at the end face value. Calculate the present value of each cash flow, you get this answer. This is what we did last week. The same thing using annuity formula, the same annuity formula. Now remember, when you substitute R here, this should be the adjusted required rate of return. What do you mean by adjusted? For the coupon frequency, we have to adjust it. Coupon rate is generally this is the required rate of return. Required rate of return generally quoted as a per annum. We have to divide this that R per annum R by required rate of return. We have to divide this by F. What is F? That is the coupon frequency. That's the rate of return that we are going to substitute. This C means coupon or the cash flow. But again, when you calculate the cash flow, remember, you have to do the necessary adjustment. This is 1 over F. Any questions? If not, okay. Did you try this exercise? And the answer is given. Hope you got this answer. Okay. Is there any question? If you don't have any questions, we'll move forward. So this is just to show you how to do this in Excel. I explained this. The function is price. There are few arguments that you have to give. First one is the settlement date. Second one is the maturity date. Remember, it's the date, not the period. Then the rate. Rate means coupon rate. Yield, what is the required rate of return. Redemption, you can give only 100. I don't know why then they ask it, but you have to type 100. Then the frequency, that means coupon frequency. It will pop up few frequencies, most commonly used frequencies. You can select one of them appropriately. Then the day count basis, whether it's actual 365 or 3360. So you can do these calculations for different day count basis. Then it will give you the answer. But remember, it is only for 100 face value. Price for 100 face value. So if we use this, say we want to calculate the bond price for 1 million, if we use the price equation, we'll assume this settlement date 15th December. Remember, in Excel, month goes first, December 2021. Maturity date December 15th, 2025. Coupon and everything is remains same. How to calculate the bond price? First we need to give the settlement date. Second one is the maturity date. Then the coupon rate, required rate of return, yield, redemption 100, frequency, this is semi-annual, and actual. You can see the price you get is 99.1084907. But we need this is for a face value of 100, but we need face value for a 1 million. How do we calculate that? What we can do, this price multiplied by 1 million divide by 100. So you get the same answer. If you use price equation in Excel, remember to adjust that for the face value if it is not 100.
So what's the reason for the answer difference in page number 43 and 45?
Page number
43 and 45, what's the reason for the difference of answers?
43 and
45.
45. Okay. What's the difference between question? Did you get this answer? First tell me that one.
Yes, sir.
Right. You got this answer. Huh? Did you get this answer?
No, I got 90.
Sorry?
This 900,000, 900,000, 90,000, 94,
This answer. Yes. Wait. Something wrong there. What is the there's a mistake, my mistake. I think the excise, it is the same question that we discussed. No? This one. Same coupon rates, same coupon rate. Sorry. Here. This is the difference. No, my question is correct. This is the difference. What is the settlement date here? It's June 15th. Our first exercise and this example same, only difference is semi-annual. If you take the second exercise and this, the difference is this settlement date. So you should get sorry, this is example. This is June settlement date. If you go to the exercise, it is, if I remember, settlement date is December. That's the difference. Did you see that? In the example, what we did, this was 15 June 2021. Correct?
Yes, sir.
So then, if you do this calculation, you should get this answer. Now you can compare 3 questions and see what are the differences and what are the differences in prices. The first one with the June 15, sorry, December 15 settlement, but with annual payments. Then the second one, December 15th settlement, semi-annual payments. The exercise, again the same question as in example 1, but with semi-annual payments.
So then the page number 45 is settlement date is 15 June 2021. No?
No. It's given 15
December.
December. This is 15th June one is the one we discussed earlier.
Okay.
This exercise, example 2. See, can you see?
Yes.
This is June 15. That's why there are 9 cash flows. But in the exercise, you get only 8 cash flows. The example 1, you get 4 cash flows because it's annual. In the exercise, you get 8 cash flows because it's semi-annual. Is it clear?
Yes, sir.
That's the difference. So if you do it in Excel, so this is when with 4.5. So this is example 1, and this is the exercise. You can see frequency 1, frequency 2. Oh, sorry, it should not be percentage. In the first example, we calculated the price of a bond with annual coupon. The exercise that I have given, I ask you to calculate the same bond, or I mean on the same face value, same coupon, same maturity, same market yield, but with high coupon frequency. That means semi-annual coupon. Then you should get this answer. The difference between this and this because of what? What is the reason for this difference?
Semi-annual compound.
Yeah, the difference between coupon payments. What is the difference between this and this? What are the terms here? What's the difference here? This is the example to
A longer maturity.
longer maturity by uh, one semi-annual period or a half a year. This one maturity is 4 years. This one maturity is 4.5. So you can see price is lower when the maturity increases. Clear? Now, if you want, you can do another comparison. Say this one, what would happen if you change the coupon? What do you expect? If you increase coupon to 6%, the price, would it be more than this or less than this?
Is there anything?
Less than.
Yeah.
If you increase that coupon rate to 6%, what would happen to the price?
The coupon amount would be higher, so the price would be probably higher. Suppose.
Coupon amount is higher, therefore price should be higher. Since the coupon amount is high, the price should be high. That's true. Still you can't see because
So can we change the coupon rate 6%?
yeah, that's what I'm going to do. Now you can see everything.
Yes, sir.
So now what we have to do? Change this to 6%. Not only price is higher, but else? You can see required rate of return is less than the coupon rate, therefore the price is
At a premium.
above the face value, trading at a premium. So what would happen if we lower this to 4%? If you change the coupon to 4%, what would happen?
Price is low.
Price is low than
Trading at
991. Okay, is it clear? Oh, so with that, I'll move into this one as well. I think that is also good at this point. This is to show you the price and yield relationship. So here you can see there are 3 bonds. coupon is 5%. Frequency of coupon payments 2%. Maturity is 20, 10, 5. Same settlement date, same maturity date, same face value. So, but I calculated the price at different yield to maturities. Use the price equation, and this part is this part. This is the adjustment, because from this equation you get the price of a bond with a face value of 100, but I need the price of a bond with a face value of 1000. So I did that adjustment. Now what is the difference between these three bonds?
Maturity.
Maturity. I think no. Before we move into this, this is good. Yeah, sorry. We'll do first this one with a single bond. So the settlement date, maturity date, coupon, frequency, and I have assumed the face value 100. So then I don't want to do any adjustment. I just put 100 here. For different maturities, sorry, different yields, the same bond calculated the price. You can see when the coupon rate is 5% and the yield to maturity is 0.5%, the value of the bond is 225.22 when the face value is 100. So this graph shows you the relationship. The yield, as you go down in this column, you can see yield increases. What happened to the price? Price decreases. But same bond. And you can see when the yield equals to coupon rate, price is 100 here. So once you plot, you can see the relationship. Remember, when the yield increases, price decreases, and it's not linear. It's not a straight line. It's a curve. We call this shape of curve is a convex curve. It's not linear. So you can try this by yourself. You select whatever settlement date and maturity date you want, and price it. So if I now this is about 30-year bond, you can see what's the price relationship. If I make it 10-year, you can see what would be the change that would happen in the curve. See, it becomes slightly less curve. The curvature decreases. It become almost straight. If I make it like 2-3 years, so if I put 25, you can see what's happening to the shape. Now it's almost a straight line, but it's not the case. If you change the scale of this, still you would see a curvature there. But however, that becomes a flat curve. That's what you can see in this. For different maturities, you can see the same thing in this. The bond A, that's the shape of the relationship. You can see it's much more curvier than the other two. What's the difference between A, B, C bonds? Maturity. Bond A has a 20-year maturity, bond B has 10-year maturity, and bond C 5-year maturity. You can see it here. So that's the shape. So when it the bond becomes, or when the bond has a longer maturity, the curvature increases. What is this? Another three bonds, except the coupon, all others are same. 20, 10, 5 maturities, same settlement date, same maturity date, same face value. What I did, instead of 5%, yield increase, coupon increases to 8%. Now what do you do? See, still the same relationship. Longer maturity have a longer curvature. Sorry, higher curvature. Therefore, when yield increases, the level of price decrease is decreasing. You can see here the bond with 5% coupon at 20% price is 266, but here it's 430. So even the difference here and the difference here may be less. What is the difference between these two last two figures? Here the difference is high, here the difference is low, because this has a absolute, in absolute terms like this, but as a percentage this has a lower rate of return. So when it goes to longer higher yields, the curves becomes flat. In this, the curvature remains there for a longer period, so the rate of return that price decrease is at a higher rate. We will divide it by the previous rate. You can see when the price, when the interest rates or the yield increase from 19% to 20%, the coupon with the bond with the low coupon 5% value decreased by 3.81%, but with the high coupon value decreased only by 3.57. So the curve becomes flat. But if we move other way, when yield decreases, price increase rapidly than this one. So these are the relationships that you should know, and you should be able to interpret these. We'll discuss this little bit more in future when we are going to discuss about interest rate sensitivity of a bond, the duration. However, this is the intuition behind that concept. But at least by now, you should understand this relationship. What happened to the price when the yield increases, and the relationship between price and the yield to maturity. Price and the yield to maturity. So it inverse and it's not a linear curve. And remember one more thing. In a moment we'll learn a term called yield curve. Yield curve. Don't get confused with that. This is not the yield curve. In this is the price and yield relationship. On the y-axis, the price is shown. On the x-axis, yield to maturity is shown. The relationship between price and yield. The inverse relationship between price and yield is shown here. This is not the yield to maturity. So any questions? Did you all get this answer, or do you have to work it out? So with this revision, I took a bit of time to do that because we are moving to the next one, where we are going to calculate the price of a bond in between a coupon, in between two coupon dates. That means within a coupon period. So just to reduce the number of cash flows, I changed the maturity date to 2023. Others remain same. Face value 1 million. Coupon date 5%. Semi-annual coupon. Maturity date December 2023. And the settlement date is 30th May 2021. The required rate of return 5.25. Now you can realize the settlement date does not fall on a coupon date, because based on this semi-annual and this maturity date, coupon date falls on every June 15th and December 15th. But the settlement date is on 30th May. So how do we calculate the price? Our basic concept is not going to change. That means we calculate the present value of future cash flows. We calculate the present value of future cash flows. That gives you the price of the bond. So can you do that? You know how to calculate the cash flows. You know how to calculate the present value. So you should be able to do that. Now, this is the last coupon date. This is the next coupon date. This is the settlement date. So we need the price as of this date, 30th May. Problem is, can we discount the coupon that you are going to receive on June 15 for a one period? So I guess if we calculate the coupon, it would be 25,000. Can we discount it like this? Whatever the rate. Can we do that? Is it the present value of this 25,000, which is going to be received on June 15th?
You have to go for number of days. No?
Yes. In between June 30th and the June 15th, there's no one period, because when we say one period in this exercise, it has to be one full semi-annual period. 6 months. But in this case, there's no 6 months. What do? We calculate the number of days in between. First, we need, again, as we did in the calculation of accrued interest, we prorate the coupon for the number of days between the last coupon and the settlement date. Here, what we are going to do, we are going to discount the cash flow for the fraction of this period as a fraction of the whole coupon period. So therefore, first we need what is the number of days for the whole coupon period. You know how to calculate it. June 15th minus December 15th in Excel. You would get 182 days. Now we need what is the number of days between May 30th to June 15th. That means what is the remaining number of days in the current coupon period. If you calculate it, it's only 16 days. How do we get this 16 days? Can someone explain how do we get this? If you don't use Excel, how do you get it?
For the month of May, 2 days, and for the month of June, 14 days.
Yes, exactly. For the month of May, we have 2 days, May 30th, May 31st, because we receive or we pay the cash flow on 30th. So therefore, for the cash flow which occurs on 30th, there's no interest for that date. So we have to calculate 30th and 31st May. Then only up to June 14, we are going to accrue interest. June 15th, we receive the cash flow. So 2 days from the month of May and 14 days from the month of June. So we get 16 days. So now what we have to do, calculate the fraction. What is the fraction of the remaining period from the whole coupon period? So you should get this one, 0.0879. Better you don't do any round off, you just keep it as it is, the whole figure. Then we'll have to decide the cash flows as we did earlier. 2 ends. What is this? This is the settlement date. What is this end? That is the maturity date of the bond. Then coupon days, we can come back every 6 months. So coupon dates would be like this. So 15th December 2021, 30th December 2021. In between that, there's another coupon date. What is that coupon date? After 30th, what is the coupon date? That's the June 15, 2021. So we receive cash flows on these days. So now, but if we have to put time here, can we put t equals 1 here? No, we can't do that. But instead of what is the time period here, it's only the fraction of the full coupon period. It's only that fraction we calculated just a while ago, 0.08. Then what's the time here? From the settlement date to December 15th, how many periods? How many coupon periods?
One
There's a
plus
full coupon
zero.
period here and a bit more. So this should be, what should be the time in here, or the number of periods here?
1 plus 0.879.
1 plus 0.87. So it is 1.0879. Then the next one, this one should be 2 plus. Likewise, these are the timings of these cash flows. Is it clear? This is as usual on this date. What is the cash flow? Is it clear how do you calculate these timings? That's the key here. When you do a bond calculation in between coupon dates, calculation of this time fraction is a key. Okay. So then what you can do, follow the usual calculation. You have the cash flows and timing of each cash flow. What do you have to do? Calculate the present value. So what is the present value of the first cash flow? 25,000 divided by 1 plus half of the required rate of return, because this is semi-annual compounding, and you discount it only for a fraction of the coupon period, only for 0.0879. The second one, same thing, but for one period plus 0.0879. Likewise, you can do this for all cash flows, the last one with the face value. Then you get this present value, this price. Clear? Any question? Yes. Sorry, can you speak out? I cannot hear you properly. Others, if you can mute your microphones, that would be great. Yes, go ahead.
When you calculate it 182 days, you calculate through Excel, or at the exam, how do you calculate? Manually.
I think we explained that, how to do.
That's
Calculate the number of days from the settlement date to the month end. Sorry, coupon date to the month end. You need how to calculate that different between two coupon dates.
yeah,
That's what your question. Whether it's a yes,
February,
between
February month, how do you get?
you just that depends on the day count basis. If it is actual, you just count up to 28. If that particular year there's only 28 days, then you can calculate up to 28. If there are 29 days, you can calculate up to 29. So in this case, to get 182 days, what you have to do? December 15th to December 31st. How many days?
16.
How many days?
16.
16. Is it correct?
You can take as, I usually take as 16, but it can be taken as 17 also. You took as
No, you can't do that. You usually take
No,
16 if you want to take it as
no,
70.
I add that last day as
Yeah, yeah, you can do that as well. So yes, the exact one is how many interest accrual days from December 15 to December 31st. Indeed January 1st, because the December 31st also a accrued date, including 31st. Without 31st, yes, 16. If we want to include 31st, 17. So there are 17 days. Then in January there are 31st, 31 days to accrue interest. Likewise, you can add them, but again, remember, in June there are only 14 days. But yes, you can just take 16, 31, and last month 15. Still, you get 182 days.
in the month of February, that how do we get that? Depending on the year, we have to get that. No?
Sorry, in the month of February,
Yeah.
yes, depending on the year. If it is not a leap year, you can take just 28 days. If it is a leap year, you take it as 29 days.
So
Because
usually
the same one day will added to this, and if it falls between either this part or this part, that will be added to here as well.
usually that given at exam is current year, no?
Sorry,
Comes that we given at the exam is based on current year, no? That's how
that depends. So the whatever the year will be given, whether it's 2016, 2017, 2021, or 2022.
So if it is
That will,
2016, we don't know that is this year or that.
huh?
If it is
You just ask from a grade 4 or 5 student. They will tell you whether it's a leap year or not. If you have to be in the treasury and you want to do the pricing, how do you do that without knowing whether it's a leap year or not? That matters not only for the fixed income, most of other calculations.
so there we have exchange.
Don't rely on those things if you don't know the concept. You will not find any error that could happen in that Excel or whatever the system. If you key something wrong, you put garbage in, you get garbage out. So whenever you get the garbage, you feel the bad smell, you should know that something wrong. That sense you should have. To have that, you should have the knowledge or the concepts behind this. Otherwise, you will go ahead with the wrong figures. So don't worry that too much. That depends on whether it's a leap year or the type of question that we are going to ask. But yes, but that can be done. That's a trick the examiners use. Give a leap year, because that's something that you should know whether this is a leap year or not, and do the adjustment accordingly. Anything else? What I can say is, if you are too lazy like that, you are not going to fit into a treasury. That's what I can say.
Okay, I just asked you how to do that.
Yes, I know you are worrying about the exam. Nothing else. So again, my at the beginning also I mentioned that don't do that. You learn the subject, you will use it anywhere, maybe in your day-to-day life also. You know the subject, then you can survive. You just study, you will get past the exam as well. You just study for the exam. There's a element that you may not be able to reach your target, getting the certificate. Try to grab these concepts, then you can apply it anywhere. Don't try to do shortcuts. Okay, any other questions? Any questions? So it's clear. So shall I show you in Excel how to do it? Can you see this properly? Can you all see the numbers and dates properly, or do you have to do? May I
It's
zoom
little
it?
blurred, like.
So can we just zoom?
Yes, I just can. That's the problem. So maybe still too big, no? You can't see the whole thing. Oh, what way you want? You want to go through these separately, and or you want to see everything
It's better if we can see the whole picture.
picture? Yes. You don't want to see the topic? That's fine. Is it okay now? But you miss this bond price between coupon days. So the face value 1 million, settlement date, maturity date. What is this rate? This is the coupon rate. And yield means what is the rate of return that you need. What is next? Coupon date, because in this definitely you need this. And the last coupon date. Then what to go? Sorry, these things, something that you have to calculate. So let me change the color. These things that you have to calculate. All these are given inputs. Face value, settlement date, maturity date, coupon rate and yield. Sorry. These two also you can decide based on the given information. What is the next coupon date? What was the last coupon date? So since it's going in the December cycle, every December and every June, there will be coupon. Since the coupon date is on 15th, or the maturity date is on 15th, every June 15th and every December 15th, there will be coupons. So the next coupon date, as the settlement date is in May, next coupon date would fall in June 15th. Just enter it. Remember, if you have to use Excel, first month, then date and the year, or use the date function, then you can put year first, 2021, then the month and the date. So then there won't be any confusion if you use that equation. And use either way, you can put it here, don't worry, date 2021 June 15. Nothing would change. You can do the same here without straight away keying the date. So then the question is coupon period, number of days in the coupon period. What do? You subtract the difference, the next coupon date. You subtract the last coupon date from the next coupon date. That's what it's here. B48 minus B49, next coupon date minus last coupon date. So you get 182. The remaining days, again, same thing. Next coupon date minus the settlement date. Cash flow, face value into coupon rate divided by the frequency. I didn't put the frequency here. I straight away put it as 2 into the equation itself. So each coupon you get 25,000, except for the last one. Last one you add the face value because you get the face value. But the key here in this example, since it's pricing of in between coupons, time periods. So what is the first time period? It is the fraction of this 16 over 182. Then you add 1 to get the next one. So you keep adding 1 to the previous one. Add 1 to the, so how did I get this? 1 plus, sorry, equal 1 plus this one. Then copy it. You get this. Okay, 1 plus the previous cell. Otherwise, you have to type 2, 3, 4. No need to do this. Then calculate the present value the same way. 25,000 divided by the 1 plus yield. Yield is given here. Divide by 2. Why? This is semi-annual. And to the power timing. A53. This is timing. So do the same for all cash flows and sum it. And if I go back here, I think the question mark comes in. What is this? The question is, what is this price? Earlier we discussed about a clean price and a dirty price. What is the price that we get once we do this calculation? I think you saw the answer. You get the dirty price. Why? We have calculated or we have accounted for the next coupon, which include the accrued interest part. Isn't it? Whatever the we use the cash flow which is to be received on June 15th and we discount it. When we take the coupon payment here, it means for the whole period, which covers this accrued interest period as well. So therefore, that gives you the dirty price, not the clean price. Is it clear? So you get dirty price once you use this method, this fundament. Okay. So then, how to get the clean price? You may remember the equation: dirty price equals clean price plus accrued interest. So this is the equation. Now we have the clean price, sorry, dirty price. We need to calculate the clean price. For that, we need the accrued interest. We know how to calculate the accrued interest. So that's what I have done here. Face value is 1 million, coupon rate is 0.5, and it has to be divided by 2 to get the semi-annual coupon amount. Then fraction it for the number of days in between the last coupon date and the settlement date. What is B50? B50 is the coupon period, and B51 is the remaining days. Once you take that difference, you get the number of days in between the last coupon date and the settlement date. Or if you want to do it other way around, you can take the difference in days, next coupon day, last difference between settlement date and the last coupon date, and use it here. So what, and divide it by 182, the coupon number of days in the coupon period. So this is the accrued interest. When you deduct it, you get this 994,09231. Now tell me whether this bond is trading at a premium or a discount.
Discount.
Still at a discount. Don't go by this dirty price. Go by the clean price. It is less than the face value, and you can see it according to our theory or what we learned so far. We said when the yield is higher than the coupon rate, it will be at a discount. So remember, whenever you do this sort of calculation, and the yield is higher than the coupon rate, you get a price higher than face value. You should realize, oh, this is the dirty price. This is not the clean price. Then you have to do the adjustment. But if you get it on a coupon date, then something wrong in your calculation. In the coupon date, what is the accrued interest? If the settlement date is on a coupon date, what would be the accrued interest?
That is 25,000. That's it.
Accrued interest on a coupon date?
Zero.
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 So let me show you. Shall I change this to 6th, 15? So, sorry, here because I have calculated it won't work. But it should be 0. If we do the calculation, it will come as because it's an equation. That's the thing. See, since I have put an equation, it will give some number. but that's the cash flow that we are expecting on 6th. In a system, proper system, it should shows as 0. I think this we will be able to avoid if we use settle difference between days. No, still it won't. So, however, this on a coupon date, accrued interest should be 0, and the price whatever we get is you can call it as a dirty price or clean price. Both are same. So that's it. One more thing. What do you think if we use the price equation? What is the price that we get? Is it the clean price or the dirty price? That's a confusion you will face when you go to real life, use these functions or a system to calculate. Rate is 5%, yield is 5.25, redemption 100, semi-annual, and this is only for 100, so therefore we'll do the adjustment. So you can see you get the clean price. Okay, remember that. If you use the price equation in Excel, you get clean price, not the dirty price. But if you follow our basic formula, fundamentals, we get the dirty price. Then we have to calculate the accrued interest separately and derive the clean price. This is true even in most of the systems, trading platforms, Bloomberg or Reuters or whatever system, or maybe internally developed systems. The yield given is to get the clean price, and it will give you the clean price, and it will give you the accrued interest separately, and then add them together to get the dirty price. So therefore, don't get confused. You get a different answer from a system if you want to do it manually and check it against a system that you can use. You won't get the answer. Remember, through most of the systems are configured to get the clean price straight away after doing these adjustments. But our method, the basic rule, fundamental method, will give you the dirty price. Is it clear? So remember that, don't get confused with that.
For once, can you just click the accrued interest formula?
Accrued interest formula, yes.
Can just move it upwards.
This is slightly different, or not exactly, but what is this calculation B50 minus B51? Let me show you here. B50 minus B51. That is 160 days. That is the difference between the. So that's the same answer we got for the accrued interest previously, I think. Oh, no, the settlement date may be different here. So this 166 days, what is this? This is the difference between last coupon date and the settlement date. We'll try that one. Settlement date minus last coupon date. Okay. Same thing, without using the dates, what I did, we have calculated the whole number of days in the whole coupon period and the days between the settlement date and the next coupon date. So once you deduct this 16 from 182, you get the number of days in between the last coupon and the settlement. That's what I did here. That's this part. B50 is 182, number of days in the coupon period. B43 is the face value. B46 is the coupon rate.
If we are going based on the actual by 365 or actual by actual basis, based on those, this same equation gets a bit more complicated, no?
Well, what do you mean same?
The accrued interest calculating formula, based on the basis that we use for the bond calculation,
Yes.
it could get changed a bit slightly here and there, no?
Yes. But there's not that much difference between actual 365 and actual. Even in actual.
Yeah, but normally, yeah, bonds are always actual by actual, is that so?
Yes. I mean, even we use actual or actual 365, there won't be
There'll be a slight difference when it comes to a leap year.
Yes, that's the only thing. Any other question? Is it clear? Shall we? Shall we move forward? So we got dirty price as I shown in Excel to calculate the clean price. We have to calculate the accrued interest. So this is the 166 days that I got in Excel. The number of days between last coupon date to the settlement date. There are 182 days for the coupon period, this current coupon period. Then the accrued interest would be this. Yes. So then use the equation that we know. Dirty price equal clean price plus accrued interest. We can rewrite it as clean price equals dirty price minus accrued interest. So you get the clean price.
So can you go to the Excel again? Yeah, interest rate was not divided by 4. No?
Which interest rate?
The coupon rate or yield.
Where?
Yeah, the accrued interest and calculate the accrued interest.
This is 2. Coupon rate divided by 2. Somewhere here the B46 is the coupon rate. So this is the face value, this is the coupon rate, this is the number of days in between last coupon and the settlement date, divided by 2 multiplied by 182, the number of days between 2 coupons. Correct.
Okay.
So the equation, once you get used to the equation and spreadsheets, you can change it slightly to make it easy. Otherwise, somewhere here you have to, if I want to correct it as what you want, it should be something like this. Isn't it? Coupon rate divided by 2. So still you get the same answer. So instead of doing that, I did this way. Any question? Is that okay? Is it clear now?
Okay, sir.
Yeah. May I go to the presentation?
Page number 51, please, sir.
51.
Thank you, sir. Thank you, sir.
So you indeed you should try this and get these answers. Just don't take a photo or note down this. Do it by yourself. Shall I move forward?
Okay, sir.
Okay. So then the new word, yield to maturity. So I mentioned even previously. So whatever that required rate of return that we use to discount the cash flows, in bond jargon, we call it yield to maturity. So we assume the bond will give us the yield if we hold this bond till maturity, that return. That's why it's called yield to maturity. If you hold that bond until maturity, that's the return that you are going to get. There are some other assumptions as well, 2 more. That's the basic idea. So that's why mostly we use it yield. Not we are not going to tell it as required rate of return, but in a way that's our required rate of return. Oh, that's the interest rate that we need. Coupon is the interest that the coupon rate is the interest that the issuer is agreed to pay, but we need more than that or less than that. So we'll adjust it through the required rate of return or the yield. Now I think you may get clear about some of the questions you had asked 2 weeks back. In a bond auction, what is the return that we get, whether we get the coupon rate or... Can you remember you asked some sort of questions like that?
Yes, even so that when we do the bids for the auction, that according to these rates, we calculate in this rate, we can bid for the auction, no?
That's the thing, that you have to bid this yield to maturity. What is the yield that you require? Your required
Not
rate.
the coupon rate.
Not the coupon rate. Coupon is decided by the issuer most of the time. Sometimes there are issues depending on the market conditions, and the issuer would like to price it at par. Then they'll adjust the coupon to be equal to the yield required by the market. Then the coupon rate and the issue yield both would be the same. Then the bond is issued at par. Then they'll get the full amount. Sometimes they do that like that, but generally, especially in government securities, coupon is announced, decided by the government, and it is announced. So that's the coupon. Irrespective of the coupon, market players, they bid what is the rate that they need. Depending on that, whether the issuer will get less than face value or more than less face value will be decided. That's why I didn't use the amount borrowed for the face value. It's not the amount borrowed that the issuer is going to pay at the end. What is the amount the issuer is going to pay at the maturity is the face value. What is the principal that agreed? But the amount borrowed may be different depending on the market condition. If the coupon rate is high and the market required rate of return low, then the issuer will be able to issue at a premium. If the yield is higher than the coupon rate, then the issuer will be at a discount rate. Then the issuer will get lesser amount than the face value. That's what happened. Now I think that question is clear for you.
Yes, sir. Anyway, that coupon will be play a major role when deciding the yield to maturity, yes, sir? Yes.
Yes. When you calculate yield to maturity, it doesn't play a major role, but there's a small impact because investors, they prefer high coupons. Therefore, there will be a more demand for that. It will be reflected to the yield to maturity when you bid it. But the yield to maturity basically decided based on the market conditions. What is the economic condition? What is the prevailing interest rates and inflation, credit risk of the issuer, things like that. Everything will be priced into the yield to maturity. But the price will be heavily depend on the coupon rate because all the cash flows are depend on the coupon payment, which depend on the coupon rate. Is it clear?
Sir, can you explain that yield to maturity again?
The yield to maturity is the required rate of return that what we use here. So in this example, the yield to maturity is 5.25. But what we assume here, we assume we will receive a return of 5.25 if we hold this bond until maturity. That is, we call yield to maturity. But when we decide yield to maturity, that means what is our required rate of return? You have to think about a lot of economic factors and the market conditions. What is the economic growth of the country, inflation, what do you think about the interest rate in future? If the economy is overheating, interest rate will go up. Then you lose opportunity to invest at a higher rate. So everything will be priced into this. And what is the maturity of this bond? Whether it's a 5-year bond or a 10-year bond or a 30-year bond. Who is the issuer? What is the credit risk of that issuer? It will be added as a premium to the yield to maturity. If we go back to the very few first lectures or the classes we discussed, how to decide the interest rate, your required rate of return. All those factors comes into play even when you decide in the yield to maturity. This is your required rate of return on this investment. All those factors are considered when you decide this. And even in the market, everything will be priced because different people think different way. But ultimately in the market, everything will be reflected. The trade will happen when the both parties agrees to a price. That means agrees to a yield. That is the market yield. Market thinks what market thinks about the interest rate for that particular time.
Also, when if banks calculate that yield to maturity, is there any common formula or something like that? No.
I didn't get that. When you calculate
the yield to maturity by banks, they do calculate, right?
That too, you can think it in two different ways. If you know the price and the cash flows, then there's no other way. What you have to do, use this equation, but unknown to maturity, then it would be a little bit complicated process how to calculate that yield to maturity. No, that depends. You know the price and you know the cash flows. Then how to calculate the yield to maturity. But I hope your question is, if you want to bid for a new bond or if you want to buy a bond from the secondary market, what is the yield that you expect? Then that depends on your market view and availability of your funds. What is the minimum return that you required and things like that. And what do you think about the issue with credit rating? What do you think about inflation? All those things matters. So then you should develop your own models to come up with a interest rate that you need. But however, if that model gives a far away figure than the market, you won't be able to trade unless it gives some advantage to the other market participants.
So excuse me, I have a question.
Yes.
Yield to maturity won't be the same as required rate of return. No?
Yes.
Won't be the same. It will be different.
Ultimately, if you want to go to the market, it would be the same. That's the return that you get. You enter into a transaction because you agree with that at that rate. Did you get that? Say you want 5%, but the market gives only 4.5%. So your required rate of return 5%, market yield is 4.5. You won't do a transaction, and you won't get that your required return. Is it clear? That's the slight difference there. If you do the trade, that means you agree to get that return. That is your required return, minimum required return.
So
There
that
can be difference what you require and what market gives. If there's a difference and it's not in your favor, you won't do a transaction.
to have a control, that's why central bank impose a cap limit, no there?
Yeah.
When during the bond auction, they have mentioned the...
Sometimes, yes. Otherwise, there will be a far away course. Yes, that is there. That's good. You remind me that central bank bond auctions. Okay. Anything else? Did I clarify that whether the yield to maturity is same as the required rate of return?
Yes, sir. Thank you.
Okay.
Sir, in central bank, do they mention the band which you should be between this and that?
Nowadays, they use the maximum yield that you can bid. You have to bid below that. So that's what. So if you go to press in the Central Bank of Sri Lanka, this gone.
Under government securities, sir.
Under government securities, it's not here. No, this is only the results. No, that's not.
Then I think press conferences.
No, there's a press releases, notices. This is the press release for a bond issue. Say 16th June, they are going to have a primary auction with 50 billion
This is
treasury
for
bills.
bills, I think. No?
Yeah, this is for bills, but still you can see most of the terms. So you can see 3 different tenors. The amounts is there. I think even here they show. See, this is what we see in the see on the Bloomberg screen last day. 5 million and multiples of rupee 1 million. So this is applicable for the primary trade, but in the secondary market, I don't think there's such restriction. There's no such restriction in the secondary market, but in the primary, this restriction is there even for bonds. Minimum bid should be 5 million, and then multiples of 1 million. So here you can see maximum yield rate for acceptance 5 to 1. That is only for 364 days. No restriction for 91 and 182 days. But for 364 days, the maximum yield that they are going to accept is 5.21. So the market knows now the next week 1 year rate should be less than 5.21. So there, in a way, less uncertainty for the market. So all the bids would be less than 5.21 or at 5.21. If you go back to the example of treasury bonds, treasury bills, treasury.
The second one is treasury bonds, sir.
This is treasury bills. In the previous page. So this is a bond auction announced for 40 billion, 2 series, 9% 2023 and 9% 2028. So here you can see maximum yield rate for acceptance 6.3 and 7.7. So no one would bid beyond above this. If they bid it, the bid will be rejected. So you can see here accrued interest amount is given. Why? The coupon cycle and the settlement date 15th April, but the maturity is September. The then cycle goes in March and September. So the last coupon previous coupon should be 1st of March, because this is a already issued one in 1st September 2012. So there was a coupon on 1st of March. Now they are going to issue it to be settled on 15th April. So therefore, from 1st of March to 15th April, for 1.5 months, there's a accrued interest. So that amount is also given. Then once you bid, and if it is accepted, based on the bid amount, you have to pay the clean price plus this accrued interest. Clear? Is it clear?
So here that coupon rates are same, that is 9%, and for the 2023 bond, that acceptance rate is 6.3 and 28 is 7.7. The variance, that is because of remaining maturity.
Just because of the maturity, yes. This one is maturity is longer than by 5 years than this 2023 and 2028. There's a gap of 5-year maturity. So the compensation is only 1.4. You are extending your maturity by 5 years. You get 1.4% per annum for that. If you go by this, but the market may be different than this.
Yes.
Basically, that's the term premium that you get, because the same issuer, that is government of Sri Lanka, coupon also, irrespective of the coupon. The difference is maturity.
So in this case, rate
It
of
means
return
when
is
you bid for yes. It means that when you bid for a 2028 maturities, that you should have some kind of better understanding about future interest rate, no sir?
Yes, you add some term premium, what would happen in future interest rate. So if you think interest rate will go up, you will try to get a higher return, because otherwise you make a opportunity loss there. If you think interest rate to go up in the future, what do?
Yes.
You invest in the short term, and once the interest rate goes up, you invest in the long term. That's what you do generally. So therefore, if you are to buy a long term, you ask more. So someone yes, go ahead.
in this case, what is the required rate of return? Is it 6.30 and 7.30?
No, 6.3 is the maximum yield or maximum required rate of return that you can ask. Okay, you cannot ask more than that. If you submit a bid 6.5, it will be rejected. But if you submit a bid 6.3, they may take it. That means you will be able to buy the bond at 6.3. Then it becomes the yield to maturity for you. If you bid 6%, that is your required rate of return. There's a high chance that you will get it. That is your yield to maturity.
Okay.
If it is accepted, it would become yield to maturity. If it is rejected, it's just your requirement, but it is not fulfilled.
Okay, sir. Thank you.
You can consider both as the same. Once you enter into a transaction, you buy a bond, you buy it at the yield to maturity, which is your rate of return, required rate of return. If your required rate of return is more than the yield given by a particular bond, you won't do that investment. Say you want to make an investment which gives a 10%, then you don't go and buy a 9% bond. That means with the yield of 9%, you don't do that. No? Then your required rate is 10%. The market yield is 9%. There won't be any trade. You won't make any investment. But if you are willing to take it at 9%, then your required rate of return is 9%. Yield to maturity is 9%. So you do the trade, you get the yield, that 9% yield. That's what happened. Clear?
It's it's clear now.
Yeah, and that's something I wanted to show here. Even here, you can see this minimum 5 million and 1 million multiples stories there. But in the secondary market, this does not apply.
The minimum quantity that they have mentioned, that is what they call as denominations, Mr. Shankar.
Yes.
You call denominations as the 1 million that they have marked here, no?
Yes.
Also, when there are multiple PDs who bid for specific YTMs, all those information are kept on public.
No. Only the weighted average.
Okay. So each PD, how much they are bidding is not public, no?
No. It's confidential. Then you know the other's position and you can. So this is the press release after the bond issue. So this is the series they offered. 2 series, maturity dates, IC numbers, coupon rates, amount offered, bids received. Say only 15 billion was offered. Bid has received 31 billion. So only 15 billion is accepted at a yield of 7.31. For this bond, 2028 one, 10 billion was offered, 23 billion, almost 24 billion worth of bids were received. Only the amount announced was accepted at a yield of weighted average yield of 8.02. Okay.
Yes, sir. Then, as per this sheet, that we can get some kind of market indication also, because
ultimately this would be the market weighted average yield.
Yes, because you are getting the more bids than the amount offered. No, that means there is a market sentiment for
yes,
long-term bonds.
There's a demand. So in the secondary market, maybe these might have traded well below this, because there are more potential buyers. They may want to buy it at, if they really want, they may try to buy it at a lower price, even say not lower price, I mean at a higher price. That means lower yield, maybe 7.3 or 7.25, something like that.
There is a demand, yes, sir?
If there's a real demand, yes. Only thing is, even though the bids received here, most probably, so we don't know, we know only the weighted average. Say when the weighted average becomes 7.31, the maximum yield they accepted maybe 7.4, say maximum 7.4, but there may be bids at 7.0 at a rate more than 7.4, 7.5, 7.6, in between 7.4, 7.5, or somewhere higher than the maximum accepted rate. We don't know. We see there's a demand, but maybe at a higher rate.
Can they offer a higher rates?
Because lowest rates are accepted here. Whatever the remaining is above that. This is the weighted average. So therefore, the lowest highest rate accepted maybe 7.35 or 7.4, something like that. Then all other bids are higher than at a rate higher than that. Did you get that? What I'm trying to say?
So in the option, are they bidding for yield or are they bidding for price?
Yield. In Sri Lankan system, it's for the yield.
So if there is, then central bank announce a maximum yield rate for acceptance. Can banks offer more than that?
Banks can put a higher rate, but thing is, it will be rejected.
Anyway, there's no point of quoting such a rate.
No point of quoting such. Yes.
So that coupon rate is 9% and weighted average rate is 8.02. So can we conclude that he is trading at premium?
I didn't hear that question properly.
Coupon rate is here 9. So weighted average rate is 8.02, right? So can we conclude that it is trading at premium?
Yes, definitely. Yes, that's the conclusion.
The other one is discount. No?
Other one is at a discount. Yes. Coupon is 6.75 and the weighted average is at higher rate 7.36.
The other thing is the most bank should be
you can take this information and try to do the price. What is the price and what is the amount that government borrows? In this issue, government won't get 15 billion because this is the face value. This is at a discount, so the government won't get the 15 billion, but less amount than that. Yes, go ahead.
Most banks, sir, most banks should be quoting rates at the maximum amount. Most probably.
Maximum.
That mentioned by the central bank that they can quote the maximum rate.
Not necessarily. That depends on your liquidity position. What do you think about the interest rate in the future? If you have enough money, excess funds, there's no place you to invest. And now, as you think, everybody will try to quote it at the maximum rate. Then there's a competition. What do? You put a bid slightly less than that. Then you will get the bond. But if you fail at the bond auction, you don't have any other opportunity to invest your cash. You earn only the SDF rate. So therefore you will bid at a lower rate. But if you don't have cash, you have any other opportunities to invest at a higher rate, you are not really interested to buy this, then you will ask return. You may quote as 7.5 or something like that. If it is within the maximum, less than maximum, or at the maximum rate.
Okay.
So investors' point of view, what would be the best option? That means you get in a discount bond or premium bond. In this scenario, that you get average yield of 7.31 against the 6.75, and for other one you get only 8.02 against the coupon rate of 9%.
Generally, there's no difference because whether you get at a premium or the discount, what you realize is the return that you get is yield to maturity subject to some other conditions. That's one thing. The second thing is perceptionally, what do you expect? If you expect to hold it till maturity, until maturity, those sort of investors would like to receive it or buy it at a discount. Then they see that you buy it at a discount and you get the 100 at the maturity, so like a gain. But if you buy it at a premium and by the maturity date, that will erode that premium, you get a lesser amount, so you feel it like a loss. But if you really understood this concept, it doesn't matter.
Yeah, thank you, sir.
Because ultimately what you realize, this yield, but subject to, you may not realize this yield, even you hold it until maturity. I'll come to that quickly. If you have it, if you don't have any more questions, we can go back to the presentation.
So I think when we do the bid, we offer the bid price, not yield, because when we see the result sheet, we can see only bid price, not the yield.
Yes, in the sheet it can be price or either way. I'm not sure. I have to check because then why they either way you can do that. Yes, because in the announcement, then why do they ask for the say the maximum yield? So based whatever the yield, you have to calculate the price and then bid. So you have to make sure that your yield is less than this and calculate the price. That is also possible. I have to check it. What
Now I have result. I can
No.
see
It's not the result sheet. If you have the bid sheet, what you have bid.
what? No.
Result sheet can be, yes. Once
Yeah.
the yield is decided, you can decide the price and send it to you. This is the result. So
Sheet they have mentioned the
either you can do whether you, because when you know the yield, you know the price. When you know the price, you know the yield. Say, assume you bid the yield, you bid the yield, then they accept it. Based on that yield, they can calculate the price, let you know this is the price that you have to pay.
Okay.
Correct? And on the other hand, they have given the maximum yield. So within that, you decide your yield. You decide your yield. Then based on that yield, you calculate the price. Then you let them know this is the price that you are going to bid. They can select that bid and calculate the yield, corresponding yield, and calculate the weighted average yield. And meantime, inform you this is your price. Either way can do. Yes, but you are correct. I was told, yes. They sort it according to the price. Yes. You are bidding at the price. Even they quote this yield, maximum yield. You quote the price. You have to put the price up to some decimal places.
Yes.
Yes. True. Anything else? If not, let me quickly finish this. I mentioned the yield is the return that you are going to get if you hold it until maturity, but it's not guaranteed. This is the part. So whatever the coupon payments you get, you should be able to reinvest at the same yield to maturity for the remaining period of the bond. Then only you realize this yield to maturity. Did you get it? So if I explain it, say 2-year bond, this is time equals 0, semi-annual, then there would be 4 cash flows. You receive a coupon here. Whatever the coupon you receive here, you should be able to invest until this maturity date at the yield to maturity, which was this yield to maturity, which was prevailed there when you buy the bond. Say you buy a bond at 6% yield to maturity today. After 6 months, you get a coupon. You should be able to invest that coupon amount at 6% for how many years? 1.5 years. Not only that, the second coupon, what you receive, you should be able to invest that coupon again at 6% for a 1 year period. The third coupon you receive after 1.5 years, still you should be able to invest it at 6% for another 6-month period. Then only you realize this 6% yield to maturity. Is it clear? Though we use this as a gauge, what is the return that we are going to receive, you may or may not realize that return. Maybe you realize more than that, or you may realize less than that. That depends on the future interest rate movement. If interest rate goes down in the future, you may not be able to invest it at the same 6%. But if the interest rate goes up, then you will be able to invest that coupon at a rate higher than 6%. So that's why we called bonds, they are 4% reinvestment risk. For you to realize yield to maturity, you should be able to reinvest your cash flows at the same rate until the maturity date of the bond. Is it clear?
Yeah, that prediction is very difficult, no, sir?
Yes, that's very difficult. Basically it's impossible for me. I think it's only by chance. You might have a lot of models and things, but it's you never know. Can whatever the model existed before 2020 January predicted this situation? No. This is extreme. Even in the normal markets, there can be things the market will drag other way. It's a very difficult. What you do a calculated guess. You calculate different scenarios with, okay, after 1 year interest rate would be 5%. What is the chance of happening this? Something like that. So any questions?
Why does it have to be reinvested? Like when you discount these cash flows, you get it like it's 1 by 1, right?
Yes, that's what you that's the meaning of discount. That's the same thing.
But when we discount, for each phase, we discount based on the return that we get. If we are getting the cash flow after 2 years, we at the initial point of coming at the yield to maturity itself, we have discounted it already. No? So why do we have to consider that we'll be reinvesting it in 2 years time again?
Otherwise, you won't realize that.
But the YTM is not based on the cash flow that I'm going to receive each 6 months. It is not already considered there.
No, YTM is that's the yield that you require for the 2-year period.
Yeah.
But you discount cash flows at different times using that yield.
Yes.
Assuming that yield will remain there for the whole period. So unless you invest that all those things at this until this maturity, you won't realize this 6 or whatever the yield to maturity that you use.
So that basic concept is that using that cash flows, that in the interim cash flows for the remaining period of maturities at particular rate. But if you use these funds for the...
I didn't get that. The basic concept is?
Yes, that
different cash
basic
flows.
concept is then when the cash flows you reinvest for a remaining period until the maturity of this bond, particular bond.
Yes.
That's why you have mentioned here 1.5 years like that.
Yes.
If bank use these funds for the loan growth in a different interest rate higher than the bond rate, then scenario would be changed, no?
Yes. No. That scenario. Yes, scenario would change. But then it's about. Then it's not. It's not about the single bond. It's about then your portfolio. What's your portfolio would generate?
Yes. Right.
You cannot earmark this is the cash flow from this bond and that cash we invested in this loan and earn this. But say another thing, you get this cash flow and grant a loan to a individual. Is it same as you are investing in a government bond?
Yes, exactly. Yes, sir. Yes.
You take high risk by giving or granting a loan to an individual than granting a loan to government or invest in a government bond. So you add that premium as well.
Yes, another clarification, sir. If that means if we raise a funds through debenture for the tier 2 requirement, say it's a 5 billion, that's for 8 years. We want to hedge that funds in a different bond. That means to compensate the interest cost in that debenture. Then it's only for the match the interest rates, no? Not for the.
Then it's a hedge, yes. You hedge your interest component. So you have a liability to pay interest. What do? You create an asset to match that.
Yes.
And then that will be set off each other. You don't gain anything. You don't lose anything.
Yes, sir.
Yes. That's right. That's the portfolio. When it comes to your portfolio, there will be assets and liabilities. You match it. You will learn it whether you keep a gap, whether you maintain more assets or less liabilities, or you maintain more liabilities or less assets. Then what would happen if interest rate changes? Whether you will going to make a profit or loss. Yes, you can't consider individually in that instance.
Yes.
Here the basic is, if you just consider a particular instrument or a particular bond, what is the meaning of yield to maturity?
Maturity. Okay. Thank you, sir.
The same concept will be applicable even for a bond portfolio. You have a bond portfolio with the YTM figure, what does it mean?
Okay.
Whatever the cash flows you receive, you should be able to invest it at the same rate until everything matures. But in a portfolio, the scenario is much difficult because there can be portfolios, bonds maturing in different maturities.
Okay, thank you, sir.
Is it clear?
Sir,
Yes.
in the bonds, is there any option for that is capitalize the interest? No. Only we have definitely we have take the interest. No.
So sorry, I didn't get that.
In the bonds, don't we have the option to capitalize the interest? No, no. We have to take ultimately get the coupons.
No, it's not. You can't capitalize this. It's interest income or interest payment.
Okay.
So this is the relationship what we discussed early. When the yield increases, price decreases, but it's not in a linear manner. It's a curve. So yield goes down, price goes up. If yield goes up, price goes down. So yield to maturity increases, price decreases. That's the relationship when we discuss here. Yield increases, price decreases. When the yield equals to coupon rate, it's at par. When it going higher, the interest rate goes up. That means yield goes up above the coupon rate. Price goes down at a discount. So this part at a discount, this part at a premium. So par is somewhere here, 5% here. This side at a premium, this side at a discount. So yield increases, price decreases in a curve, following a curve. The curvature depends on the coupon rate and the maturity. That's what you see here. Clear? Any questions?
Sir, can you
When
go
we
to the
come into
expense
yield
sheet?
to maturity, sir, that means when investments in bonds, that there is a we have to give more weightage to the investment risk also, no, sir?
Yes, when you bid, you have to think about the reinvestment risk. Yes, but whether you will be able to invest that cash at that rate. That's what you meant, isn't it?
Yes, yes.
Sir, can you go to that Excel sheet?
Try to generate this by yourself. Put the coupon rate, frequency, maturity, settlement date, and maturity date. For easy, use the settlement date as a coupon date itself. Then the face value, different yield to maturities, and you can use the price equation. Then plot it in a graph. And you can play around, change things. Maturity, if the maturity period increases, then I couldn't find how to do this. Say, if I change this, is there any way to change this automatically in Excel? I couldn't find anything. So if you can find it, you can put the equation here. Whenever you change the maturity, even the maturity date will change. Everything will be adjusted automatically. Otherwise, when You change the maturity period, you have to change the maturity dates. Different coupons, or you can plot these two in a one graph and see what's the difference. So this is the result. Series 1, Series 2. Series 1 is the first one, bond A, with a coupon of 5%. Series 2 with the coupon of 8%. You can see the difference. You can see the gap is increasing here. That means the red color one is more curvier than the blue color one. This is because of the coupon adjustment. And since the coupon is high, price is high for the same yield. But when it comes to the end, the difference narrows. Okay, anything else? Shall we take a break here?
Sure, sir.
Okay, we'll take a break about 15 minutes. After that, I'll show you how to calculate the yield when we know the price. We'll do this in Excel. You can't do it manually. I'll show how to do it in Excel. Okay, let's take a break. Shall we start? Are you ready?
Okay.
Shall we start? So I'm going to show you how to calculate the yield. So there are two ways. We'll use the same price what we get here. Okay. So I'm going to show you how to calculate the yield to maturity. So for that, what we need, we should know the face value of the bond, coupon frequency, and maturity period, and the price. What is the price that we are going to pay today? Then we can prepare a cash flow. In this, we need at time 0. That means today we are paying. So therefore, we have to put it as negative as well. So this is a cash outflow. But from year period 1 and onwards, we have positive cash flows. So once we prepare this cash flow, we need this cash. We need this information just to prepare the cash flow, and this is the price that we pay to buy this bond. Then we need to calculate what is the yield of this. For that, what we have to do in Excel, there's a function called IRR. So select the all cash flows, and in that we have to give a guess first what would be the result. Say if we assume 3%, it is 3%. We can add it as 3%. Just enter. It will calculate this and give you a yield. Now you can see it is on. It gives us 2.62. But if you go back, we got this price when the market yield is 5.25. Why did we get this 2.62 here? This in IRR, it assumes this single period. So this is the yield applicable for a one period, but market yield is for a year. Here one period is semi-annual. This is annualized figure. So therefore we have to multiply this by this frequency. Then you get 5.25. Clear? Was it clear how to calculate the market yield?
Why was the assumed 3% inserted?
No, we have to give, because this is an iterative process. So first try one figure and see whether you get this in IRR. What they try to make the NPV equals 0. That's the concept. IRR is the one where net present value equals to 0. So what Excel tries to discount all these cash flows and calculate the present value of those and set off against this figure and get the answer 0. So it's to discount this, it requires a
So
initial guess. Then
even if you put
discounting at that rate, then see whether NPV is positive or negative. If it is positive, what would it do? It will increase that rate slightly and see what would happen. If it is negative, decrease a bit. Likewise, it's a iterative process. To start that, we have to give a initial guess. It doesn't matter whether it's 1%. It doesn't matter. You can.
All right, fine. So
it's a guess.
Until it automatically gets the calculation NPP to 0, it keeps
going
the rate.
adjusting that figure, and yes, that's what it does. To start with, we have to give a guess, but it's better if we can give a closer figure. Say now we know the coupon is 4%, and this is 955, so less than that. So indeed, I should have give a rate, say more than 4%, because I know the coupon rate is 4%. It has a discount. Definitely the yield should be more than that. But remember, again, 5%, it's okay. But here it says it considered this 5% as the one period interest rate, but it's not. Here, maybe guess around 2.5 would be the best half of this, and slightly above that. You can use your that knowledge to tailor-made that, or there's another way that you can do it. The other way is have this cash flow, without this cash flow, then calculate the present value. Okay, instead of use IRR here, you put a guess, 3% or something like that. Then calculate the present value of all these cash flows. That's the way we did earlier. So this is the present value of this cash flow at this 3% yield. Do it for all these cash flows. Then take the total. And now you know if this yield is correct, this should equals to price. So if I put 2.275 5.25 divided by divide this by 2. So when market yield is 5.25, you should get the price. Okay, but we don't know what is the yield. That's what we are going to find out. So we put, it will give something like this, but we know the price. This is the price. We can put this price here. And what is this total? This is price. Calculate the difference. Again, there are two ways. First, I'll explain the first one. When we have this prepared, the yield we have 0 here. If you want, again you can make a guess, like say 2. Then still you don't get the correct price. What you can do in Excel, there's a tab called data. Go to that. Then there's a what if analysis. Select this. Then go to goal seek. Then it will give you a dialog box like this. Set cell. That is what we want to ultimately set. So what we need, price. So as the set cell, select the not the price, this total to a value. What is the value we need? We need this price. So we can't select that price. We have to type it 955,424,54. And now we can tell change in what the system should try to set this value to this cell value to the figure that we have given. So changing the yield. Now it says okay. You can see it went through few iterations and the market yield is set to 5.25, and then now you can see the price is correct, exactly what we want. That's a one way. If you want to keep the results, just press OK. The other one is again I'll put this 3%. The other method is so instead of typing that what is the target we want, other one what we can see is calculate the gap between this total and this price. So the difference plus 95.5 minus this. Either way, it's okay. Now it gives a difference. Again, we can follow the same steps. Goal seek. Set cell. Still, what we want to set the cell. Now, not this one, but the gap. We want to set the gap to what? What should be the gap? When we calculate the price properly, what should be the gap?
0, right?
0. Yeah, set the gap 0 and change in the cell. What is the cell that we want to change? The yield. So, okay. Still you get the market yield. Now gap is 0 because the total comes to same as the price. So that's how you can use Excel to calculate the yield to maturity when you know the price and other terms of the bond. So, but remember, when you use IRR, you have to adjust the answer according to the coupon frequency. In other two methods, when we use goal seek method, we don't have to do that because we have already adjusted it in the present value calculation. We have divided that by 2 or whatever this frequency. Clear? So this is just for your knowledge. If you are going to use Excel to do these sort of calculations, you can use this IRR function or the goal seek function in data what if analysis. If you cannot see this what if analysis in this for the data tab, you have to go to this and options and select the data analysis adlins. In adlins, here you should be able to add it. Analysis. Okay, shall we move back to our presentation? So here what we discuss, what is the relationship between yield to maturity and price. When yield to maturity increases, price decreases, and it's not a linear relationship, it's a convex relationship due to this equation. See this equation, this is not a linear equation. P and R are not linearly related. That's why it happens that way. Any question? So remember, yield and price is like a zero. When one side goes down, other side goes up. Then there's another measure called current yield. This is a very simple measure. And don't get confused with the current yield. It doesn't mean the current market yield to maturity. Current yield has a specific meaning when it comes to bond market. So what is it? It's the coupon amount for a year divided by the price that you pay. That's why it says coupon rate into face value. It doesn't adjusted it for coupon frequency. So coupon rate into face value, what does it mean? It's the coupon amount for the whole year divided by price. It is called the current yield. That sort of give you indication for the price that you paid, what is the gain that you get through coupons. But it fails to account for the future cash flows and its timing. And capital gains or loss. This is just an indication of the cash flow, what you receive as a coupon and as a percentage of the price that you invest. But there may be capital gain or capital loss in the future. It is not reflected through that. Can someone tell me how can you get a capital gain or loss in the future?
Sell it for a lower rate than you bought. Yield.
Sorry?
Sell it for a lower rate than you bought.
Okay, if you sell it at a lower rate than you bought it, what do you mean by rate? First
yield. If I bought it for 5.25, let's say I sell it for 5.5. So on the day of my sale, the actual value and the selling value difference will be the capital gain.
Yes. So you bought it at 5.25, you sold it at 5.5. Will it be a profit or a loss?
It will be a profit for me.
Profit for you.
Yeah, gain for me.
Okay. Any other answers?
So when the market yield changes from time to time, the yield that you can get from this asset would change and the price would also change. So if you sell it for a different price than you buy it, you can get a gain or loss, right?
Yes, that can be a loss because if market yield has increased now, when the yield increase, what happened to the price?
So price would go down.
Price go down. So then you incur a capital loss. Forget about, so in this capital gain or loss, you don't consider about whatever the interest income that you have received, if any. Okay, for that we'll do this. Not this. With something. Okay, this one. Remember this price, clean price. Shall I put it here? What is our yield? 5.25%. Okay. Say, assume after the next coupon is June 15th. So before that, you sell it. Assume 10th of June. If still the rate is 5.25, price is 994,175. Something. This is the settlement date. Settlement date. So you bought it at 994,092. What's happening here? And you are selling at 994,175. Gain or loss would be this minus this. Remember, I used clean price. You don't consider dirty price for the capital gain loss because it will cover through the accrued interest part. Whatever the accrued interest that you paid, whatever the accrued interest that you receive, the difference would be your interest income. It's not the capital gain or loss. So the clean price, you earn 82.79. But still, remember, we didn't change the yield. Even the yield remains same, you make a capital gain. Why? So if the yield remains unchanged, there shouldn't be any price change. But in this instance, there's a price change. What is the reason?
The period, right?
Yes. Now we have less or shorter period. So then what would happen? price would go closer to face value par. Okay, so therefore that effect is there. I'll come to that one as well. So yield 5.25. Assume yield goes to 5.5 or 5.3. Just a small. Now what has happened? Oh, it's better to link this straight away. Now it's a loss. Just a from 5.25 to 5.3, 0.05% increase in the yield within 10-11 days time. You make a capital loss, but that may become a capital gain. Say you hold it for a 1 year or 2 year period. That is the maturity effect. Sorry. Yes, settlement date 2022 June 10th. So you hold it for a 1 year period and sell it. At that time yield is 5.3. You make a capital gain. That because there's an impact of the yield as well as time to maturity.
So can you explain that again?
Okay.
How you gain and loss?
Yes. What I did, say, how did we calculate this? We calculate the price, assuming we buy this bond on 30th May. Is it correct? 30th May. If we buy it, how this figure change?
If you can link those, it will make sense.
No, we can't.
5.25.
I mean the date.
Sorry. No. The problem is yes, at 5.25. We bought it on 30th May with 5.25 yield. What happened? Sorry, 0.0525. Now it's okay. Correct. Yes. This is our first position. That means we bought it on 30th May when the yield is 5.25%. This is the clean price that you have to pay. So you can. I just copied it here. Correct. Is it clear? That's the clean price that you paid to buy this bond on 30th. Then what I did, I changed this settlement date to 10th June without changing the yield. Yield remains the same, but we have moved forward in time. So now we are in 10th June. Yield remains same. What is the price? The clean price is this. So you have make a capital gain. Is it clear?
Yes, sir.
Okay. Now what I'm trying to say, time change, not only time, even the yield. If yield goes to 5.3, what would happen? By 10th June, yield has gone up by 5 basis points. So then you incur a loss. Is it clear? Because yield increases, then price decreases generally. That's the concept. But when we say yield increases, price decreases, we assume all others remain same without changing the time. But in this case, the time also changes because you don't buy at the same time, and you can do on the same trade date as well. Sorry, settlement date as well. No problem. Even that you can make a gain no loss by changing the yield. But more to be more practical, you buy on a one day and you sell it on another day. Now yield has increased, you make a loss. But what I'm trying to say, this 5% or the 5 basis point yield increase 5.25 to 5.3, it won't matter if you do it after a 1 year period. Then you make a profit because your remaining maturity is less now. It's only 1 year now. Earlier it was 2 years, now it's only 1 year. So therefore it can turn into a profit. Is it clear?
Yes, sir. Okay now. Okay, thank you.
Anything else? So if you want to do this in the same day, on 30th, no? We don't change the settlement date. This is the price that we pay when the interest rate is 5.25. Now assume yield increases to 0.5053, to make a loss. On the same day, if yield decreases, you make a gain. That's the capital gain or loss. But that can happen even in between two different dates. However, when you consider two different dates, you have to think about the time effect as well as the yield effect. Generally, when we say yield, when yield goes up, this relationship, we assume same date. But this is true even for a very short time period. But for longer time period, this may not exactly have the same impact because time factor moves the price other way around. Remember, I said the time factor moves the price other way around. Why is that? So I'll come to that. Is this correct or understood? How to make a capital gain or loss? Assume instant capital gain or loss. You buy it at a particular rate, then the yield moves. You make a capital gain or loss because the moment the yield changes, price changes. Is it clear? Any questions? Oh, shall I explain it again? Hello, can you hear me?
Yes, sir.
Yeah.
Yes, sir.
Okay, so tell me whether to go ahead or you want me to explain it again.
I think this part is clear. Okay.
This part is clear. Okay, basically assume no date change on the same value date, but the yield changes, so the price changes. Therefore, you make a capital gain or loss. But that can happen even the date changes, but depending on the time period, it can be a gain or loss, even the yield increases. Because instantaneous yield increase would result a loss. But if it is in between or in two different dates that happens, then we are not sure whether it would be a gain or loss. That depends on the time difference as well. So to yes,
you can sell it in the same day for different price and you can make a gain. That is
make a gain. Yes. So that's why mostly when you do trading, intraday trading, that's what you do. You buy or sell, or you sell and buy.
so as long as there's demand, you can make a gain.
You can do that. Yes. But no need to be intraday.
Yeah, but if the date changes, that
Then you have to do the calculation and see whether
get,
this whether this gives you a profit or a loss. What is your buying price? What is the current market price? Whether it gives you a gain or a loss. That can be done. Okay. Now
within the day even that changes YTM?
Sorry?
Within the day also that changes that YTM?
Yes, definitely.
If it changes only that we can make a gain or loss within the day.
Yes, and it should be substantial, because when you buy at offer rate as a market taker. If you sell, you sell it at the bid rate. So the market should move beyond that spread. Otherwise, you can't do that. Still, you make a loss.
The YTM is remain same if we settle within that means within the before the maturity, we can make a gain also, no? Even without.
I didn't hear the first part.
Even without change in the YTM, if we, before the maturity, if we sell or buy.
Yes. Say, okay, that's another good one. Say, assume we remains at 5.25. So there's no capital gain, no loss, because same settlement date. And okay, now assume we move to December 30th, and the yield remains same. It would be a profit. Yes. But we may have to do a change here. Next coupon date and the so better. We have to change this one as well. Even the previous calculations, that effect may be there. We have to change whenever we change the settlement date. We'll have to change this one as well. Forget it. But that can happen. Say 30th May, we'll put it as 10th June. We are in the same period, so you can make a gain. Is it clear? So we just change the settlement date. We move forward bit in the time. Yield remains same. Still you make a gain. If you go further down, still that can happen. I'll show you how could that happen. And this can happen only if you have bought it at a discount. Okay, to show you that, we'll go back to 30th. Instead of 5.052, assume you bought it at 475. Then the price should be, this one should be days. Correct? 30th May, yield is 475. So this is the price that you pay to buy. Now assume on 10th June you sell it. No change in the yield. Now you cannot expect a profit. Now you should expect a loss. Clear? Whether it gives you a profit or loss when the time get closer to maturity, that depends on whether you have bought it at a premium or a discount. Is it clear?
Yes, sir.
Okay. If not, we'll move into that. We'll move into this slide, this sheet. So 3 different bonds, bond A, bond B, bond C. So this is the settlement date, July 1st, 2021, with a maturity of 20 years. So maturity data, July 1st, 2041. Same coupon rate, same face value, same frequency, same maturity for years, but at different market yields. One is at 7%, one is at 8%, one is at 9%. Okay. What do you know about this? This bond will be traded at par, premium or discount. Bond A.
Discount.
Discount.
Excellent. Why it's at a discount?
The yield is lesser than the coupon.
Premium.
When the yield is lesser than the coupon,
Premium.
is lesser than the coupon, it should be at a premium. So this bond will trade at a premium. What about this? It's at par. This one at a discount. So what I have done here, different time to maturities. At the beginning, now we have, when the settlement date is as this, we have 20 years. So I have priced the bond, 3 bonds on that date as of July 1st. You can see the price is above par. This is at par. This is below par. So at a discount. So then I change the settlement dates exactly, reducing for moving in one year forward, reducing the time to maturity. Initially it was at 20 years. By 2022, remaining maturity time to maturity 19 years. Likewise, on the maturity date, time to maturity is 0, and I have priced the bond. So you can see this one. What happens? It starts with 1106.8. I didn't change the yield. It's 7%. Remains unchanged, but the maturity goes down. What happened? The price decreases, and on the maturity date, it comes to par. Clear? So that what it shows here. When the bond is issued at a premium, yield remains unchanged, then what would happen? When it reached maturity, price starts to decrease, and on the maturity date, it reached par. Assume no change in the yield. Still 7% yield. Clear? Then we consider the second bond. Coupon rate equals to yield. So irrespective of the maturity period, you can see it at par. All the time, it remains at par. The third one, which one is at a discount, you can see with the time what would happen. Price increases, and on the maturity date, it reaches par. So this is the. So therefore, if you buy a bond at a discount and hold it, there's a, we call it carry. Because of this time, you getting closer to par, you earn a income or you get a capital gain. But if you have bought it at a premium, with the time what would happen? Premium goes down with the time, and on the maturity date it should reach par. So you make a loss. So that's why the answer to the one of the questions that you asked previously, whether you should buy it at discount or a premium. If you buy it at a discount, at least you have some gain here. Even the interest rate increases in the future, your interest will be invested at a lower rate. Your realized return maybe, but in this case, it's a different. But if you can maintain your yield to maturity, that's the return that you realize. So whether you bought it at a premium or a discount, it doesn't matter. You realize your yield to maturity. If you can invest coupon payments at the same rate, otherwise it won't be the case. Is it clear now how the bond price change over time?
So in this case, I can assume that yield remains same, right?
Yes, yield remains same. If this won't happen practically, time to time yield change, then prices go up and down. This was the one which is at premium. Tomorrow may be at a discount. Then the one is already at a discount will be at a higher discount. So if the yield goes down, the bond which is at a discount today may be trading at a premium tomorrow. So then in that case, the bond which is trading at a premium today will be at a higher premium. Even the one which is trading at par may start to trade at a premium. That depends on the yield movement.
So when you say yield, so that means what you want to make out of it or what the market considers it is worth?
Yeah, that's what market considers, because at that time, at that rate, the price is decided. If you trade on that, that's what you earn.
Okay.
Or what you like to earn. You may not earn the exact thing, but that's what you want to get.
But when you buy it at a premium and knowing that you're not going to realize that, why would you do that? Like
No, that's the thing. That's the thing. If you can say in this bond, so this is at a premium. But if you can invest your coupon flows in future at the same 7%, ultimately you realize 7% gain. That's your return, your yield.
but you're getting an 8% coupon, right?
Yes, that's right. So the premium that you pay will be
Is
offset
coupon. Okay.
through some of these coupon payments.
Coupon payments. Okay.
Here, what you get at a discount, again, the compensation is through the coupon rate.
The coupon.
This time you pay it.
Okay. Okay. Thanks.
Okay, there's another thing. If we go to this pricing, you can see the present value in this, say, before maturity, the coupon plays a major role. So most of the thing to the price given by this, and only at the end you get the face value. But say when the time to maturity decreases, so assuming this out of all this cash flow, what is the weight here? Present value. So 2.43, 2.43, like that. But at the end, you get 88.42. What would happen when we decrease this? Say now this is at now still there's about 4 years maturity. No, 2 years maturity, 2.5 years maturity. What would happen when it comes to 1 year maturity? Then you don't get this coupon, all these three. When it comes to 1 year maturity, you will get only the last two, 1 year semi-annual, you get only last two cash flows. Then out of which the percentage or the contribution from the capital is high. When you have only these two cash flows, the more weight is coming from the capital, not from the coupon. That matters here. That's why it ultimately reached to.
Smashank, a small thing.
Yes.
Now, if you go back to the other Excel that you are in.
This one?
Yeah. Here, now up until the capital repayment, the other is called the coupon interest. No?
Yes.
So, is there any interest for the capital that we accrue?
Yes and no. Yes and no both. You can consider this one. Say if you bought it at a discount.
Yeah.
When it comes to par.
Yeah.
That's the gain that you get.
Yeah. Yeah.
So when you calculate the yield to maturity, that gain is also considered.
Okay, that gain is also considered.
Yes.
But the thing is, there is we have a separate accounting terminology called coupon interest.
Yes. In the coupon interest, you count only for this interest income.
Yeah, that's right. So how about the capital that we have bought it for a discount, where
Yes.
we'll be getting, that is what you call price interest or something.
No, you might have heard about amortization.
Yeah, amortization. Yeah.
You take this difference and amortize over time and change your book value. In this case, your book value will increase.
Yeah.
Gradually, but in this case, your book value will go down.
Yeah. So, is that what you call the effect of price interest?
Effect of
price interest?
Price interest?
Yeah.
I'm not sure. The effect of price interest. price interest. Maybe I have to check it.
Okay, fine.
I haven't heard about it. I see.
Yeah, okay.
Generally, the word used, this is amortization.
Yeah. Price interest, I think, don't know whether my terminology is different. It is also
Yes.
somewhat we arrive at the present value.
Sorry?
It is also something like where we arrive at the present value.
That yes, that can be, yes. It may be yield to maturity. Refer to yield to maturity. We can just do a Google and see whether there's term like that. Where have you heard it?
Basically in systems, because when we buy the let's say we bought the bond at zero year after it's maturing after 20 years. So at the point of 15 years, if we are to arrive at the carrying value, we need to add the cost coupon interest as of that day plus the price interest. So that's why
You add the coupon.
Accrued coupon interest. Accrued coupon interest.
Accrued interest. Then price value means that amortization. It can be negative.
Amortization, no?
It can be negative.
Yeah, it can be negative also. Yeah, either way.
Then this is amortization. Should be.
It should be amortization. No?
Seems like that. Yes. Okay. Anything else? Anything else? What shall I move to? We'll try to finish this. So this is the current yield. So try to identify the relationship between current yield and the yield to maturity. Think about when the bond is trading at par, at a premium and at a discount. What would happen? So we'll move forward. The yield curve, which I mentioned earlier, don't get confused with this. This is not the yield curve. Still, I have seen when I asked to construct a yield curve or show a yield curve, student draw this. This is not the yield curve. This is the price yield relationship. What is the yield curve? Yield curve is, or in other terms, it's called term structure of interest rates. It shows the relationship between time to maturity and yield. So if you have a 20-year time to maturity, what is the corresponding yield? For a 10-year maturity, what is the corresponding yield? For a 3 months, what is the corresponding yield? So this is an example. This is Sri Lankan government yield curve sometime back in 2011, September 2nd. So you can see on the x-axis, the maturity is given 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 4 year, 5 year, 7 year, 8 year, 9 year, 10 year, and 15 year. What this dot reflects, for a 3-month maturity, what is the yield? It's just above 2%. What is for 6 months? What is the yield? It's around 2.2. Likewise, for the 15-year maturity, the yield required is almost 9.5. So this is the yield curve. It shows the relationship between time to maturity and the yield. On the x-axis, the time to maturity. On the y-axis, yield. In the previous graph, price yield relationship, yield was on the y-axis, price is on the, yield was on the x-axis and the price on the y-axis. Clear? What is yield curve or the term structure of interest rate? So there can be different shapes of the yield curves: normal, flat, inverted, humped. So we'll go through each and see what are the different shapes. I can say the one I showed you previous, it's a normal curve where it's not exactly theoretically normal curve, but where with the increase of maturity, yield increases. That's the normal yield curve with the upward slope. When the maturity increases, yield increases. It's a we call it a normal yield curve or a positive yield curve. This one you can see a different shape at the initial with the maturity, interest goes up, then yield goes down, again goes up. This may be considered as a hump, but when we call it, this is also again a positive yield curve. This can be considered as humped, initially down, then again up. So if I draw different yield curves here, simply in a normal yield curve, what we expect curve to be like this. So increasing. In a negative yield curve, it's other way around. When it goes down, yield goes down, negative. In a flat one, what do you expect? Here, when the time to maturity increases, yield goes down. In a flat one, we expect no change in interest rates, whatever the maturity. For same maturity, we charge the same interest rate. In humped ones, we can have different shapes. It may be like this, or it can be like this. This is much better if I can like this. These are we called humped ones. Upward sloping, that's a normal curve. Downward sloping, inverted yield curve. No change with the maturity, it's a flat humped one. In the middle belly of the curve is higher than the other two, or the belly is at lower than the long end and the shorter end. So these are the different curves. Okay, how do you interpret these yield curves? That's a more important thing. Normal yield curve, that means like this upward slope curve. What do you expect when you see this type of yield curve? Short-term maturities, interest rates are low. Long-term maturities, interest rates are high. There are different theories on this, expectation theory and things like that. I'm not going to discuss all those things. Then it will be like a economic class. better if you can read it and get to know about it. But generally in the market, how do you interpret when there's a positive yield curve or a normal yield curve? Market expect future interest to go high, or in future interest rates to increase. Then we will see a normal yield curve. In the inverted one, that means something like this. What do you expect then? In the inverted curve, you expect future interest rates to go down. When you see an inverted curve, yield curve in the market, you should expect some sort of a recession kind of thing. That's an indication. In a flat one, you would see a coming to a peak or a drop. That means you're almost at the top or a bottom, or there's no difference for the time. What do you expect in the humped one? For the first, in this case, for a shorter period or until the mid, interest rate would increase, then interest rate would decrease. Here, initially interest rate would decrease and then interest rate would increase. That's the some sort of view of the market when we have these different yield curves. And the other thing is steepness of a yield curve. Steepness means the difference between long-term yield and the short-term yield. When the gap between short-term yield and the long-term yield is high, the curve is deep. So it can be like this. So short-term interest are very low, long-term interest are very high. Or it can be like this. Start somewhere here and ends up somewhere here. So this one is, we call sort of flat. There's no that much of steep, but in this it's a very steep curve. Slope is high. Then how the yield curves change? It won't remain fixed forever. Time to time it changes. In a parallel shift, what do we expect, or what do we see? For each maturity, the yield changes by the same amount. Yield changes by the same amount. If it is a curve like this, once it's a upward shift, assuming if it's it's an upward shift, it can be either upward or downward. The new line, I cannot draw it now properly. It should be a parallel one to the existing one. There cannot be like this. So the change is same everywhere. That's a parallel shift. Non-parallel shift, it can be anything other than that. What can happen? Say short-term interest increases by a small amount, but long-term interest increase by a large amount. So this one, that's a non-parallel shift. Or that can happen not only in increase, even in decrease. If the yield curve moves down, that means yield decreases for each and every maturity by the same amount, then it's a parallel shift. Different maturities by different amounts, it's a non-parallel shift. So based on that non-parallel yield curves, these shifts, there are again few things. Twist in a slope. So that means the shape, it can be changed somewhere here. Rather, this is the existing yield curve. The next one would be something like this. Short-term interest increases, long-term interest decreases. That's the twist in the slope. It can be a change of hum. So earlier it was like, say, for easy, it was like this at the very first instance. After the change, it can be something like this, or it can be other way around. Yield increases, but like this. Or it can be like this. Oh, I mean, I want to like this. Two ends yield drops, but the belly yield increases. So any sort of things. That is the non-parallel yield curves. So flattening mean as I mentioned, very steep curve becomes flat. Steepening means flat curve becomes steep. Positive butterfly means change in the humpness. So in the positive butterfly, yield curve becomes less humped. That means earlier it was like this. Now it becomes like this. Yield has increased, but in the longer end and the short end, increase is higher than the intermediary area. If yield decreases, it's other way around. Long maturity sector decrease less than the yield in the intermediary maturity sector. The example that I showed, this is the first instance, this is the new curve. Then the yield has increased, short end and the long end by a large amount, but intermediary area by small amount. The same thing can happen if yield decrease, the yield in the short maturity and the long maturity sector decrease less than the decrease in the intermediary area. If you plot just the change, it would be something like that. That's why it's called a butterfly. This is the change, not the curve. This is the change. Interest increase more in the short end and the long end. Intermediary area, interest increase only by small amount. It's like a butterfly. That's why it's called positive butterfly. The next one is the negative butterfly. In that case, when yield increases, long end and the short end increase by small amount, and the middle sector, intermediate area, yield increase high. In the decrease, it is reverse. So most common types are steepening, downward shift with the steepening of the yield curve, or an upward shift in the yield curve combined with the flattening of the yield curve. The thing is, what would happen when interest rate start to go up? It's cost to the firms and participants in the economy. So therefore, in the future, the interest rate comes to a peak and hold it. So therefore, short-term interest increases while long-term interest at least remain almost at the same level or decrease. So therefore, the curve shifted like this, from this shape to this. So that's what happened. That's what I drew somewhere here, like this. From this to the changes. So becomes more flatter when interest rate started to increase. So therefore, upward shift with a flattening. But what would happen when the interest rate started to decrease? Initially, it would become a inverted curve. Then when it comes to a bottom, then the shorter end interest rate is low, then you have access to funds at a lower rate, then the economic activities would start to pick up and give a boost to the economy. That would create a long-term interest to, or in the long-term interest to go up. So therefore, in that situation, short-term interest goes down and the long-term interest goes up. That's what happened generally. And these are the most common movements. But depending on the situation and the circumstances and other conditions, that most may not happen as the way we expect. Again, this is a very tricky area. We should be able to forecast what would be the changes in the yield curve, as someone asked earlier. This is the tricky part. We should be able to forecast what would be the future interest movements. However, if you consider the volatility, that means how frequently and by amount, if you calculate the standard deviation of the change of interest rate, short term is more volatile than the long term. Long term interest rates are anchored around some figure and move up and down around that by a small amount. But short term, it's not like that. It will fluctuate here and there more frequently. So the volatility is high. So now we have to discuss about the risk of investing in fixed income securities. I think we should stop here and start this next week. So do you have any questions on what we discussed so far? And remember, when we discuss about market risk, this duration, again, we are going back to that pricing equation and do similar type of calculations. So please remember those. And the shape of the price and yield relationship, the steepness of the curve, how that change. It's all about this duration. So please remember those when you come to the next class. Okay, any questions?
So excuse me, is there a way we can buy past papers from the institute?
I'm not sure. I don't think they don't sell these past papers of this course. Yes, now initially what we thought, because we were planning to have the exam in March for the last batch and give that paper as an example to you. So seems it's getting delayed, and some might heard in the morning we discussed, Menaka and myself. So in these situations, we are not sure what would happen. Maybe the possibility, I'm seeing that chances are getting high that both groups may have to sit the exam same time. In that case, you won't get that paper. So I'll arrange you to get the 2019 paper.
Okay, sir. Thank you.
That will help you, yes. But you have the sample questions that I gave.
Yes, we have.
So those are almost, some are just to, if you do that, you will get bit more clarity on some concepts, and almost same questions will appear in the paper as well.
So is there a website or something like that we can do example calculations other than the paper provided by you?
I don't think there's no such open source, but there may be sources, yes, even some YouTube things, and maybe from universities or some other institutions, those who have these sort of courses, they might have put their assignments or papers on the web. That sort of things may be there, but not sure.
Okay.
And if you get that sort of things, just make sure that the market conventions and things are the same that they discuss.
That's the thing, no, sir. But depend on the country.
Yes, yes, but that's true. Depending on the country, your application would change. That's why I am asking you to learn the concept. Then what you have to do, when the conditions are changed or the market convention change, what you have to do, just change the application. Just without going by, okay, number of days divided by 365. Don't go by like that. Because in our market, we use 365 or something like that. Don't use 3 as a or robo or mechanically 365. Remember, why do we use this 365? If you are to apply the same concept in one for another country or another currency, then you have to first think about what is the applicable day count basis, what are the applicable conventions. Then, but still the same concept. Concept won't change. That's why I'm asking you always get the concept, then find out what is the market convention, apply that to that. If you just go for just follow the convention, you don't know why are you doing that. You just put okay, that's it. That's what you do. You don't know why. Don't do that. Any other questions?
Inward yield curves are usually existed in the market, so it's not.
Yes. During recessions, that happens. If you can go back around 2007 and get the US yield curve, you can clearly see a inverted yield curve.
Is it in 2007? No?
Yes.
In that case, that market expectation is that interest rate goes down.
Yes, because they see with the GFC coming in, they see that that's going to happen. So that happened.
Okay.
Anything else?
So will you share recordings last week? Recording also not in that mail.
It's not yet. Okay, we'll check. I don't know because they cannot go to office still, so that may be the reason.
So I think we will be requiring the new handout. I think
Yes, for the next week we need a new because there's only few sites to go in this. Yes, I'll post it.
I think if we can get a little earlier, it will be better.
Yes.
Yes, thank you.
So once we finish that assignment, do we need to upload that to the classroom?
Yes, through Google Classroom. Then it will check all these plagiarisms and everything. So don't worry about it. The system will handle that.
So in that case, are you all, I mean, submitting a plagiarism report there itself that we can view that? Because we are taking certain items from the websites. We can
So
reference.
that's what I mentioned. So use proper referencing. Either there are different ways. Either you can quote it in the report, or you can paraphrase it. Even you paraphrase it, you have to say the reference. Even you quote it, you have to say this is the reference. So the whole report can't be all quoted from other places. So you can refer all those things, understand what does it say, then write it in your own language. I'm not sure whether probably it should give you give the I'm not sure whether it will give you the report. I don't think. The plagiarism report, I'm not sure whether it will give you, if it will give us the report.
Okay, sir.
If we take some ideas from that one of the websites, and if we mention in our words, still do we have to refer that? So should we?
I didn't get that.
Let's say if we take some idea from one of websites, if we may write it in our own words, still
Yes,
do we have to
yes.
refer
It's not your idea. No, the concept is, or the idea is not yours. So then you have to give the reference. That's the concept of plagiarism.
the website like Wikipedia, Wikipedia is okay, no? We can refer those.
So make sure that those things give you reliable information. That's it.
Okay, sir.
And remember, the things in websites changes time to time. So there's a way of referencing when you use internet as reference. So follow that better. You make it a habit. That's good even for your official work as well. Anything else?
So there are various reference types are there in the Microsoft Word. In that, can we use what kind of
Whatever you think, it doesn't matter. Yes, there are different ways. Yes.
What do you call? Is that okay?
I think there's one called Oxford.
Yeah.
Something like that. That there are few ways, but
is that okay if we use Harvard Anglia one?
Use the one that whatever it's okay. Yes.
Thank you.
Anything else? So, shall we stop here? Okay, then if you don't have any questions, we'll stop here. And remember, next week what we have to discuss again is something to do with calculations and the way we use pricing. That equation is still used. The method we used, it's duration calculation is, so remember that. Okay, see you.